Thank you, Kevin. My name is Ralph Rocco, and I joined the merger arbitrage team at Gabelli in 1993. Today I'm joined with my partners, Willis Brucker and Paolo Vicinelli, who are going to talk more about the M&A and financial engineering and how we've seen that to surface and grow value. So, financial engineering and M&A is a natural focus of our firm, since private market value with our catalyst methodology, coupled with our value research, deep focus on value research, leads us to follow companies with undervalued and underappreciated assets and managements who are looking to surface that value. As we heard from Mark Gabelli early this morning and heard it a few times today, private market value is the price that informed industrialists is willing to pay for those assets. And the catalyst that we're talking about today is financial engineering and M&A. And it's so important that we've written a white paper, multiple white papers on the subject. Chris Morangi, our co-CIO, has written a couple iterations. You could find it on our newly revamped website. And in it, we highlight the different ways of financial engineering, be it through an IPO, a subsequent exchange offer, a spin-off, reverse Morris trusts, Dutch tenders, buybacks. All these can be done to surface value and even make it more attractive for the ultimate financial engineering, which is an M&A transaction, which we've seen can also surface value. Some names that recently have announced, in the white paper, Chris talks about John Malone and Liberty Media, really one of the most prolific and successful users of financial engineering. We honored Greg Maffei and his management team last year, just highlighting the many ways of they using tax-efficient financial engineering to grow and surface value. We saw earlier that Liberty Broadband announced a merger with Charter. We're basically getting a quarter of a share. They're also simultaneously spinning off their Alaskan telecom business, GCI, which basically eliminated the discount that used to exist and surfaced some value for an asset which was underappreciated. So definitely John Malone is definitely on the Mount Rushmore of financial engineering. ITT, which we heard of earlier today, has also had a history of financial engineering going back to their conglomerate days when they owned assets such as hotel gaming, Hartford Insurance, Continental Baking, Avis Rent-A-Car. And that restructuring was done in the late 90s. And then we saw even more recent years when they spun off into three separate companies, spinning off their defense and water business, leaving a more highly focused company that we heard from Luca earlier on high precision engineered products in markets such as industrial, transportation, and energy, and how he's augmenting M&A to accelerate the growth of that company. Sony, we heard earlier today that they're spinning off their financial services business. 80% will be distributed to shareholders. That will surface value in an underappreciated asset. Could also give us an opportunity to buy an asset once it's distributed from the mindless investors that we talk about sometimes, the index funds that may have to dump those shares. We could buy something at an attractive valuation, an attractive asset. They're also announcing a 250 billion yen buyback, or about 100 million shares over the next year to further surface value. U.S. Cellular, after a couple years of prodding, they finally found religion and announced a couple years ago they were looking for strategic alternatives. That culminated in the announcement of U.S. Cellular selling essentially most of their assets to T-Mobile for about $4.4 billion, including about 30% of their spectrum. They subsequently announced a sale of about a couple billion in spectrum to Verizon and AT&T. That stock has traded, and its 83% owner, TDS, has traded up 250% and 300% Since they announced they were seeking strategic alternatives, U.S. Cellular trading in the low 60s and TDS in the low 30s, in mid 30s. Our analyst, Sergey Dolchevsky, our telecom analyst, has PMV value of low 80s in U.S. Cellular and high 50s, about mid 50s in TDS. So there's still some room to achieve his PMV, although they probably will require further financial engineering. And just Kellanova, it's at the bottom of the screen. They used to be part of Kellogg's. A couple years ago, we had Kellogg's essentially spin off their U.S. cereal business. The remaining company, which was their snack business, Kellanova, within a year, they attracted a Mars, which found that business to be yummy, and made an $83.50 bid agreed deal to acquire them for $30 billion. So you can see how financial engineering really created that opportunity to acquire that business, and with a great, about over 50% premium. And then, of course, Command, we saw earlier how they really restructured that business and were able to come to an agreement to be acquired earlier for $46 a share, over 100% premium to really surface value. So you can see how obviously M&A is an important driver for surfacing value. And with that, I'm going to turn it over to my partner, Willis Brucker, who will talk more about the current environment for M&A activity. Thank you.
Thanks, Ralph. So Ralph just zoomed in on a pair of transactions that were recently announced and executed, Command and Kellanova. With apologies to Tony Bancroft and Ian Walsh, I'm going to take us to 35,000 feet for an overview of where the M&A market is today. So the market is on track for its second consecutive year of deal volume growth. In the first quarter of this year, we're up 15% compared to 2024, up 6% sequentially from the fourth quarter of last year. So these are both encouraging trends. Apologies. Notably, Europe was a bright spot with M&A totaling about $150 billion. That's a 12% increase. Cross-border activity, very active, 40% increase to $280 billion. And private equity remains acquisitive. They've accounted for more than 20% of deal volume, and they are sitting on about $3 trillion of dry powder to deploy. And now that we're starting to get more clarity on tariffs, we're expecting deal volumes to heat up further. And that's because corporate confidence increases when CEOs have a better ability to forecast how his or her company is going to perform in the future. Anecdotally, we're hearing from bankers that M&A activity has picked up in recent days with people getting more comfort on tariff situation and with China. Last year, we showed this graphic to preview the upcoming election between Donald Trump and Joe Biden. We know that a lot has changed in the last 12 months. But what we now have is clarity on what the Trump administration's priorities are, and that's based on the team that they have assembled. So to borrow an analogy from basketball, the team that Trump has on the court is vastly different than the team that Biden had on the court. And I know what everyone in this room is thinking. Yes, isn't this situation a lot like the New York Knicks? This is the team from 4 years ago. Starting lineup, totally different when we fast forward to today, and they're on their way to an NBA championship this year. Yes. So all this is to say that the team that you put together matters, very much so. So who's on Trump's team? Well, the two most important people, Andrew Ferguson, head of the FTC, Gail Slater, head of DOJ antitrust. The recent public comments are very encouraging. And here's what we expect from them. The pair have said that they will enforce antitrust laws where there is a clear competition concern. And when they don't see a concern, they will, quote, get the hell out of the way. And this is a marked departure from the Biden administration's approach of slowing reviews, needlessly sending deal reviews into phase 2 extended inquiries, and attempting to move the goalposts by using untested economic theories. And these aren't just words. The Trump administration has actually reinstated early terminations, whereby deals that pose no competitive harms can be approved sooner than the statutory 30-day limit, and we're already starting to see deals approved on that shorter timeline in just the first 3 months of the administration. Trump's picks for other important regulatory positions are also supportive of an improved M&A environment. Brendan Carr at the FCC, Paul Atkins at the SEC are both strongly in favor of less government interference and deregulatory actions. So Brendan Carr, for example, at the FCC can smooth approvals for mergers in the media and telecom space, as well as the potential to repeal the broadcast ownership caps. That would really encourage consolidation among the broadcasters. So all this is to say, we think that all the ingredients are in place for a strong wave of M&A. That is robust appetite from corporate acquirers, dry powder from private equity and private credit acquirers, rather, and a more accommodative antitrust environment, regulatory environment globally and in the US. And so to discuss ways that we utilize our core competencies in financial engineering, I'll hand it over to my colleague, Paolo.
Thank you, Willis. So you heard Ralph talk about financial engineering, Willis talked about M&A, and I'm going to talk about how we use our compounded knowledge in these two areas to earn a return for our clients. And it begins with a handoff. This is a picture of Eli Manning handing the ball off to Orleans Darkwa, but what it is it's a depiction of what happens at our firm every day when a deal is announced. And what we mean by this is the transition of a stock under coverage of our value team to the merger arbitrage team. So sort of the transition of a stock from a value investment to the announcement of a deal to then an arbitrage opportunity. And what do we do in merger arbitrage? Well, we invest in announced deals. So we buy the stock of a company that has already agreed to a takeover, and we earn the spread between where we buy it and the takeover price. And we can do this with dozens of deals in a portfolio or a fund and generate returns that are consistently positive and are not correlated to the market. Mario touched on this earlier, but we've written 2 books on the subject. Deals, Deals, and More Deals is sort of our primer on how we invest in announced deals, and then Merger Masters is a compilation of interviews with hedge fund and mutual fund managers who we think are very good in the arbitrage business. Now, of course, we have our own arbitrage fund, the Gabelli Associates Fund. It was launched in 1985, and so it has a 40-year track record. One more sports reference. In baseball, they talk about the 40-40 club with players who hit 40 home runs and steal 40 bases, a really unusual combination of power and speed. We have our own 40-40 club today because this is the 40th year with which we've had this symposium. It's also the 40th year during which we've managed our merger arbitrage fund. So the Gabelli Associates Fund is the fund that we're referring to. It has compounded over those 40 years at 7%, so at a 7% CAGR with a very low degree of volatility, and it has generated positive gross returns every year since 1987. So before I wrap up, just to go back quickly to what Willis covered, is M&A and why we think it's such a good time to be investing in M&A. We spend our days speaking with corporate management teams and a lot of people that are involved in M&A, and what we hear now is that there's very significant pent-up demand by companies to do deals. So we think over the next 2 to 3 years, you're really going to see a big resurgence in M&A. Obviously, that bodes well for our team. It bodes well for the fund. And to conclude, we talked about financial engineering, we touched on M&A, arbitrage, returns, and I'll leave you with a quote from our initial book, which was, "The announcement of a merger for us is the beginning of an opportunity." Thank you for your time, and now I think we're going to pass it over to Mario and the team for Q&A.
This podcast is an excerpt from the GAMCO annual meeting on May 16, 2025. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic, and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. Investors should carefully consider the investment objectives, risks, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800 Gabelli or visit www.gabelli.com.